Hi and welcome to Swissquote's Daily Market Talk. It's Monday, January 12th, and the headlines are nowhere close to being boring. This Monday, the Fed and its head, Jerome Powell, are under the spotlight, facing the Department of Justice of the United States over their HQ renovations, though Powell is probably right when he says and insists that this is not about the renovation itself, but it's mostly about interest rates and the Fed not hammering the interest rates to the low levels as desired by the US government. Elsewhere, and for those who are still interested in data, last Friday's US jobs data sent the yields higher in the US, but the market shrugged off the worries quite fast as the Fed's RMPs and government's proposed mortgage-backed bond purchases will likely keep liquidity flowing. And liquidity is good. Investors love it, but it also raises inflation risk, obviously. So where to go in this environment? We will talk about that in detail. But before we do, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So the year continues at full speed as we are the second Monday of the second full trading week of the year, with data, political and geopolitical headlines all very interesting and also worrying. Last week this time we were talking about oil in the context of the US capture of you-know-who in an overseas operation that actually contrasted with international law and sovereignty. Oil and oil stocks fluctuated throughout the week as the US said that it wants to rebuild Venezuela's aging infrastructure to pump that oil and sell it. Following that, US government and big oil giants has talked last week, but ExxonMobil said last Friday that Venezuela was uninvestable, and Donald Trump answered that they will then keep Exxon out of Venezuela because he didn't like their response. So here we are. Here, as everywhere else right now, the US government's intervention in corporate affairs will have a heavy impact on the winners and the losers, probably. So if you want a complete understanding on why the stocks move the way they do, well, looking at Mr. T's social truth feed would give you a better understanding and probably better explanation than traditional data and earnings. Anyway, SPDR's energy ETF hit a record high last week, then retreated and then closed the week on a positive note. Crude oil tested the 50-day moving average to the upside and gap opened above this level this week, but bullish bets in favor of crude remain very limited still. The net bullish positions are around 15-year lows right now. And that's because there is ample supply in the oil market today thanks to record US pumping and OPEC's oil restoration strategy as well. So it's hard to see oil bulls clear important resistance levels. Important levels include that $62.50 per barrel level, which is the 200-day moving average, and the $64 per barrel level, which is the major 38.2% Fibonacci retracement on June to December sell-off. So price rallies are seen as interesting opportunities to strengthen short positions targeting $53 to $55 per barrel range. Coming back to the headlines, well, this week, Jerome Powell and the Fed are on the front page of Bloomberg News as the Department of Justice of the United States is now going after Mr. Jerome Powell and the US Federal Reserve for Powell's congressional testimony on ongoing renovations of the Fed's headquarters. These news just fell on Friday, and Jerome Powell hit back yesterday saying that this has little to do with the HQ renovations and more to do with the fact that Mr. T is not happy with the Federal Reserve's rate setting policies, the fact that the Fed is not willing to cut the interest rates as much as he would love to, and also highlighted that the latter development will be important for whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I'm afraid we are moving toward the second option. The Fed could soon turn into a political tool and its head could be replaced by a government puppet. That would, in return, mean a further loss of appetite in the US dollar and also the US bonds. But for those who are still interested in traditional kind of economic news, well, last Friday's US jobs data was mixed. The US economy added around 50,000 new non-farm jobs in the month of December. That was fewer than expected by analysts. But the unemployment rate in the United States fell and average earnings growth accelerated. So the overall take was that the US jobs market weakens, but at a moderate speed, and that the Fed may want to wait before cutting the interest rates this year. So the US 2-year yield jumped to 3.54% on Friday after the data, and the probability of a March rate cut fell to 40% from around 50% a week ago. The equity market's reaction to the data was surprisingly positive, however, because the small cap index added 0.78% on Friday, while the technology-heavy Nasdaq 100 gained more than 1%. And that optimism is certainly based on the fact that whatever happens with the interest rates, the Fed is injecting money, liquidity, into the financial system through its new RMPs, reserve management purchases, and the US government now suggests to buy around $200 billion worth of mortgage-backed bonds to reduce housing costs. So it's not called QE, but the ingredients are very much similar to the Federal Reserve's purchases of government bonds and mortgage-backed securities under the much-loved QE program that injected tens of billions of US dollars into the financial system for years. It's not exactly the same, the timing and who is buying is not the same, but no matter who injects cash and how, the Fed or the government, in short or long-term bills, well, the outcome for the market is ample liquidity and investors are loving it. So there's no reason to exit the equity space, even less so as the measures should, in theory, further pressure inflation to the upside, and exposure to equities could eventually help investors manage that risk of rising inflation. Speaking of inflation, the US inflation data will be one of the major data highlights of this week. Remember, the latest US CPI report released last December was marked by very questionable statistical malpractice, like keeping the housing inflation at 0% because of lacking data instead of extrapolating or putting there an average, which resulted in questionably weak inflation numbers for the US last December. So this week, we will have the fresh update to these US inflation data with the headline figures seen stable near the 2.7% level. Let's see what will come out of that data and what will investors think about it. A set of higher than expected inflation numbers should further tame the Federal Reserve rate cut expectations, push yields higher but not necessarily tame equity appetite due to ample liquidity, while potentially softer data will be subject to close watch in terms of how it has been calculated and whether it really represents the reality. Again, if the Fed can set its policy on economic data and if inflation picks up momentum as a result of it, you'd be better in asset classes that will temper inflation risk for you, and that would be gold, commodities, inflation-linked bonds, chart tips, dividend-paying stocks, and probably technology as well. So speaking of technology, Asian technology stocks kicked off the year outperforming the US peers. TSMC announced last week that its revenues topped estimates last quarter, and the company will release its earnings this week to remind investors that AI investments continue to feed through and will continue to provide sustained revenue to AI enablers. Enablers are chip makers, data center providers, etc. But the valuation gap between the US and Asian technology companies suggests further inflows toward the latter, toward the Asian technology companies, and the latter is also backed by earnings growth expectations. Because looking at the earnings growth expectations, EPS is expected to grow by 79% in South Korea and by 36% in Taiwan, while it's expected to grow only by 28% for Nasdaq, according to Bloomberg. So the Korean Kospi has started the new week with a fresh record high, unsurprisingly, while the Chinese Hang Seng Index is up by 1.20% at the time I'm talking here. Just saying, it is probably going to be another very interesting week, so stay with me. But this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.